What's up, guys? It's your boy August BTC back again with another video. So we're going to continue talking about or explaining how crypto options trading works. So we've done part one, which is partially successful, and now we're going to dive into part two. Number one is the strike price, expiry, and premium. So what does this actually mean, and what are we talking about when we're referring to this? A strike price is basically a particular price that you choose for your option to expire at, basically. Okay. And again, everything is related: strike, expiry, and premium. So strike is the price that you choose. For Bitcoin, you can choose a strike price of 70K, 80K, 50K, 10K. Expiry is basically, as it spells out, the date, expiry date, when the option or when the contract is going to expire. It can be in 2 days, 15 days, 1 week, 1 month, 1 year, 2 years even. And then the premium is basically premium. I look at the premium as the credit that you collect if you sell an option, and or a debit that you pay when you buy an option, if that makes sense. Okay, so I'm going to obviously explain this in a simple manner with an example. But what I like to do is, when it comes to the premium, I like to be paid premiums. I like to receive credits. Okay, so that's what I like to do when trading options. But let me explain what that means, looking at a real example. So again, we here on the testnet platform on Deribit. Okay, this is a demo account with fake money. And just to show you guys what I mean here. So if you look at the Bitcoin, right, we're dealing with Bitcoin to make it easy. These are the expiry dates here. You see on top here, July, August, and it goes all the way to June 2027, right? That's about literally 1 year out. Okay, so if in August, that's 20 days out. July 31st, that's 6 days out. Okay, so that is basically the expiry. And then the strike price is basically what you see here. Literally says your strike. So strike is basically this the price action here that you see. So you can basically choose any price action that you want here, from low to high. And then this purple price here is the current price of Bitcoin. You see Bitcoin is sitting at 64,100. The purple line will always reflect the spot price, more or less, of Bitcoin. So we have to be really mindful of this. Is what you need to look at. Okay. And then the purple strip here, very important, basically is the expected move. So basically we're saying here, if you select each different strike, you will see how the expected move is going to change, right? If I select July 27, you see how it's a bit smaller. But if I select December, you see how it's a bit larger. So the expected move basically tells us, or basically tries to calculate more or less where Bitcoin is expected to move in the next 6 days for this particular expiry date. Yeah, very simple. When it comes to the premium, you need to look at the bid mark and ask price. Okay, but I usually look at the bid and ask price. This is very important this is basically the premium that you either get paid, received when you sell options, or that you buy, basically, okay, or that leaves your account when you buy options, if that makes sense. So if you selling an option, you always look at the green section here, right? And then this is a put side, this is a call side, and when you're selling options, you always look at the green line here. These green values here, the bid side, and if you buying options, you always look at the ask price, the red side here. Cool. So that's easy. Now the next step is we're going to look at the two type of options that they use. It's either a call option or put option. So first things first, it can go different ways. You can either buy a call or sell a call. We're going to first look at buying a call. So buying a call means you pay a premium for the right to buy an asset at a set strike price before the expiry. So you're betting that the price goes up, and your only cost is that premium, right? Nothing more. So the good thing is, when you're buying a call, the max loss is already capped at the premium you paid. So no matter how far the price crashes, your maximum loss is just a premium. But then the profit is unlimited, because when you buy a call, you're basically betting that the price is going to go up. And if the price continues to go up to infinity, you profit. Let me give you guys a very simple example of how a call, buying a call would work. First things first, you need to look at the side. This is the call side here. So you'll be looking at this, the left-hand side here. And you want to buy a call. Now, and again, you can select any strike price that you want to select. I'm not really going to get into the technicals as to what is the best strike price to choose. I'm just going to, again, you can select any strike price that you want to select here. So let's say you wanted to select, let's use a real, again, remember buying a call, you need to have in mind that it's a bet or prediction or speculation that the price is going to go up. So currently Bitcoin is sitting at 64,100. So now you're saying, okay, I think before the end of the month, which is July 31st, remember the expiry, you're saying that, okay, I think before the end of the month, Bitcoin is going to be above 64K. Okay. So if you're predicting that Bitcoin is going to be above 64K, what you can then do is you can select a strike price that's below 64K or run about at 64K. Very simple, right? You can also say, okay, you're predicting that Bitcoin is going to be above 70K by the end of the month, by July 31st. Again, you can choose 70K as your strike price. And for you to really, really profit, Bitcoin will have to move from here all the way to 70K and above for you to be in a very tremendous amount of profit. All right. So anyways, let's just say, okay, cool. Let's say we use this probability game, the expected move, and then we say, okay, in the next 6 days, Bitcoin is going to be above 67K. So all you do is you click on here, the strike price that you want, you click on here, it's going to be highlighted. And then you can then see how much it's going to cost you. Because remember, when you buy a call option, you pay a fee. The fee that you pay is a premium. And remember, we always look at the red side. So if I want to buy, it's going to cost me $275 to buy one contract. So when it comes to Bitcoin, on the options chain, this is all for one contract. So let me open this. You click on it again. So it can show you here that the minimum contract that you can open, because I'm doing, Bitcoin inverse options. Let me just show you guys very quickly. I'm doing this inverse options. The reason why I'm doing Bitcoin inverse options is because it's much more liquid compared to doing Bitcoin USDC options, right? The liquidity isn't so great. So I prefer to choose this, and I would recommend that you guys always work with inverse options for Bitcoin or Ethereum on Deribit. Very important. Okay. All right, let's proceed. So I'm going to click on here. Okay, and then the minimum amount of contract that you can sell here, the smallest is 0.1 Bitcoin. So again, remember, it's going to cost us $200. So we click here, and then we do one contract, and then we click buy. There we go. So we successfully bought one whole contract of Bitcoin at 67. So if I scroll all the way down here, you will see this is a fee that we paid, the average price, and basically money left our account. If I go to the transaction log quickly here, you'll see that money left our account. You see, so this is what we bought here, right? We bought 67K strike by one contract, and you'll see the cash flow is negative cash flow. That means money left our account basically when you buy a call. Well, it theoretically didn't leave your account, but that's how much it cost to. Because if I go back here, we should still have. Okay, it was 800. Yeah, we should still have 4,800 basically, right? So it's not like your money here is going to disappear, but that's how much it costs you to open the position. Okay, so it costs you about $200 and something to open that position, one contract. So this is basically what buying a call means. So if Bitcoin in the next 6 days doesn't go above 67K, you lose all this money. So the position will expire and you're going to lose all the money. But in the next 6 days, if Bitcoin goes above 67K, we'll be making a tremendous amount of money. I can assure you that. If Bitcoin goes above 67K, even 68K, or sometimes what happens is Bitcoin can literally start moving up to like 65K, 60. So the closer it gets to 67K and above, you start making money. Right now we're in a loss because we just opened a position. So that's essentially what buying a call means. All right. Now, next topic, buying a put. So buying a put will be basically doing the same thing, but then when you buy a put now, you're predicting that the market is going to crash. So people that buy puts are people that are a little bit bearish. Bearish meaning if they don't have conviction that the market is going to go up, they have conviction that the market is going to go down. Okay. So usually when people buy puts, they want to protect their account from crashing. So if they feel like we're in a bear market like we are right now, and remember, we said that Bitcoin is in a bear market because it's below the 200-day moving average. What traders would do is they would buy a put option to hedge their downside. Okay. So same thing. When you buy a put option, you pay a fee, and the fee that you pay is a premium, and the maximum loss again is a premium, right? So if Bitcoin goes up, the maximum amount of loss is your premium. And it's very important, guys, to know how much you lose. When it comes to trading, it's very important to know how much you're at the risk of losing. Very important, because you cannot just go blindly open up trades. It's never really good to have, number one, unlimited risk to either the upside or the downside. You always need to have a known risk, and you always need to try and keep your risk as small as possible for you to be a profitable trader. So let's have a look at how buying a put would work. So again, what I will simply do is I'll be looking at the put side here. Remember, when we buy a put, we're saying that we're bearish. So we're saying, okay, I feel like in the next 6 days, Bitcoin is going to be much lower. Or actually, let's just say by August, let's say the next month, the next 30 days, August 28th, you feel like, okay, you know what, Bitcoin is going to have a massive crash. I don't know when. It might not be in the next 3, 4, 6 days, but in the next month, Bitcoin is going to crash. So what you can simply do is, again, you choose a strike price. So again, we're going to choose 72K. We're saying here that essentially that, okay, there's no liquidity. As you can see, I cannot buy or sell. Sometimes this happens, guys. Sometimes this happens. So you can either set a limit order and wait, but I don't usually like to wait. I like to have a market order. So what we're going to do, we're going to choose something a little bit closer. Let's choose 69. It's not working. Let's choose 66. Okay, 66 is working. So let's choose 68. Okay, let's choose 67. All right. So here we're saying here that in the next, okay, it went back out again. Again, the reason why it's, this is a demo account, right? This is a demo test net on there, but so liquidity is not always the best because this is not the main net. This is not a main network. This is a test network. So because I'm showing you guys on the demo account, yeah, we might not get some fills. So let me get closer here just for an example. I'm going to buy one contract here and then create order. There we go. Right. Also, another thing to look at is the maintenance margin, guys. Very important. This thing cannot go to 100. If it goes to 100, your whole account will be liquidated. All right. So essentially what I have now, I have a call option and now I have a put option. So remember, for this put option, we basically said that, and we paid about 3,600, right? I think we sold here, cost us, yeah. So here, cost us a lot more money. Right. So here we're saying here that, you know what, in the next 30 days, August 28th, we don't think Bitcoin is going to be above 66K. So we're predicting that Bitcoin is going to be way lower than 66K or below 66K in the next 30 days. And we paid $3,000 for this contract. So if we are right and Bitcoin crashes, we're going to receive a lot of money. But if we are wrong and Bitcoin is above 66K by the end of August, we lose this entire amount. Oh, so now we're going to be looking at selling a call and selling a put. So selling a call is basically income plays. When you sell a call and you sell a put, you're going towards the play of income. Again, selling a call, you're basically saying here that the market is going to crash. So selling a call is you're bearish, right? You have a bearish conviction on the market saying that, you know what, I think the market is going to crash down. So when you sell a call, that's what happens, right? So again, this is a prediction that the market is going to be down, right? But then when you sell a call, you sell your position, right? You're going to get paid in advance. So selling a call means you collect premium upfront in exchange for taking an obligation to sell the asset at a strike price if the buyer exercises it. So you're basically betting that the price stays flat or falls down. I love selling calls, guys, and selling puts because I get paid and I love getting paid. I will not just give money for free by buying, but I prefer to receive money by selling. Okay, so let's quickly look at an example of selling a call. Again, we'll be looking at the call section here. All we simply do is come here and say, okay, you know what? In the next 30 days, I think that Bitcoin is going to be below 72K. the next 30 days. We're selling outside of the expected move. I'll probably sell 0.3. There we go. Much more realistic. So now I sold the contract. I sold 0.3. So to see how much you got, you just do 0.3 multiply by this amount here, which would then be, let me see, for a calculator right here, 0.3 times 480. Sorry, 0.3 times 480. So I basically received $144 into the account by selling at this level here. All right, so here's a position here. So basically what needs to happen here in this instance is that if the market crashes, I make a lot of money, right? But the maximum amount of money that I'll be making is 0.3 times this amount, which is, like we calculated, $144. So I cannot make more than that. That is the only caveat when you sell a call or sell a put. The maximum profit will be equal to the premium that you receive. That is your maximum profit, but the maximum loss is unlimited. So if by the end of the month, Bitcoin is above 72K and even higher, my loss will keep on growing exponentially if I don't close a position. All right. So very important, guys. When you sell a put, you are actually bullish, right? You believe that the market is going to recover, Bitcoin is going to go up. So selling a put is actually a bullish stance or bullish position. Okay. So you're saying, you know what? I believe that Bitcoin is going to bounce. Let me sell and get paid for it. All right. So that's basically what it means. So to show you guys how to sell a put, again, you look at the put side here. You look at the green, this is how much you get paid. And you can say, you know what? I think Bitcoin is going to be above 58K by August 28. So we click here, and then we're going to sell 0.3 contact. I'm going to sell 0.3, sell. There we go. And now you would have seen that I've sold a put here. So this basically means, so I received, if I do 0.3 times 800, I received $240. So if you take $240 plus the $144 that I received here, the total amount of profit that I stand to make is $384. So what does that mean? That means if the market stays exactly where it is right now in the next 30 days, in the next 34 days, I stand to profit the entire $384. That's the great thing about selling options. That's why so many people like selling options, because you get paid immediately. So the cash stays in your account, and for you to capture it, you just have to wait for the position to expire. Or you can also close for profit early, right? Once this thing goes in green, you can close it for profit early. All right. So essentially that is what selling is. But remember the risk. The risk is on this put, if Bitcoin dumps or crashes below 58K, your loss is unlimited to the downside. Well, not unlimited because it stops at zero. So if Bitcoin crashes to zero, you will have a massive loss. Okay. So that is basically what it is, guys. And yeah, so we're going to stop here today. I hope you guys like the content. Part 3, we're going to continue covering Crypto Options 101. And yeah, so if you guys like the content, feel free to drop a like, comment, subscribe, and I'll see you guys in the next one.